The largest part of the move will be driven by a sudden lack of supply, as Western institutional actors now seeking to move to a 40-20-20 allocation to gold from zero allocations increasingly competes with the inelastic central bank demand, where it will at best estimate require $8,000 gold, just scroll down, to bring sufficient bullion to the market to meet this enormous demand. There is insufficient physical to meet this enormous inflow of demand. And not to leave silver out of the equation, as we've said before, the best consensus is $80 silver, and that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200.
A structural shift is unfolding in the precious metals market as physical demand increasingly overwhelms legacy pricing mechanisms. The tightening supply conditions, ongoing backwardations, and rising global arbitrage activity signal that Western paper markets are losing influence over absolute bullion pricing, as central banks, sovereign buyers, and institutional allocators aggressively increase their gold requirements. The available above-ground supply is proving insufficient at current levels. This tightening dynamic is becoming visible through widening basis spreads and repeated instances of synthetic pricing failing to align with real deliverable metal. Andrew Maguire, a longtime whistleblower on paper market distortions and a seasoned physical market analyst, explains that the next phase of price discovery is being driven by direct competition between Western portfolio reallocations and inelastic central bank flows. His analysis points toward higher structural price levels becoming unavoidable as the gap between synthetic liquidity and physical availability continues to widen across global hubs. Current projections place equilibrium gold levels near $8,000 once institutional demand entirely shifts into the market. At the same time, silver's tightening profile aligns with shorter-term targets near $80 and with extended structural estimates between $140 and $200. With physical premiums rising and liquidity migrating toward eastern settlement centers, the market is preparing for a repricing phase driven by real supply constraints rather than leveraged flows. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Now, in the bigger picture, we're drawing closer to the end of 2025, and to illustrate just how well physical gold and silver has acted as wealth protections since we opened this year, and here's where we opened, it now requires over $1,550 more to buy the same ounce of gold, and from where we opened in 2025, over $23 more fiat to buy the same ounce of silver. Now, what we're doing is reaffirming and in real time updating where we see these fiat to physical balance points as we move forward. Now, whereas it seemed a stretch at the beginning of the year to extrapolate the $2,900 opening price to $4,500, which was our original projection, now we've got lots of company with almost every single bullion bank looking at $4,500 to $5,000 gold in 2026. And bearing in mind, 2026 begins in just 5 weeks, and we're in sync with our very same reliable liquidity providers who are assessing a doubling of the gold price by the end of 2026. Now, we'll be tracking this closely and sharing this along the way. Now, the largest part of the move will be driven by a sudden lack of supply, as Western institutional actors now seeking to move to a 40-20-20 allocation to gold from zero allocations increasingly competes with the inelastic central bank demand, where it will at best estimate require $8,000 gold, just scroll down, to bring sufficient bullion to the market to meet this enormous demand. There is insufficient physical to meet this enormous inflow of demand. And not to leave silver out of the equation, as we've said before, the best consensus is $80 silver. And that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200. So what we look at here is for stackers to be able to shake off the smoke and mirrors legacy market shackles and to join forces with every single central bank and sovereign investor now racing to exchange their rapidly debasing fiat currencies, treasuries, for real world zero counterparty risk bullion. There simply isn't enough above ground bullion to meet this demand at current prices. That's true for both gold and silver. So let's start with the first clue, the unprecedented backwardations. This is an action call and a massive opportunity to front run the next leg higher. Futures market backwardations to spot, what they do is telegraph the legacy December gold and silver futures prices, which we've just been tracking, have been physically mispriced. Now, hang on, this is the largest largest price setting futures exchange globally, paper futures, cash settled. So basically, these December contracts, which everyone looks to for a reference, have been physically mispriced. And while the spot market is influenced by these diluted prices influencing the local London fixes, where deliverable bullion can be sourced, because it's diluted with synthetically generated, unbacked 96% leverage COMEX supply, the exponentially larger global-facing T+1 deliverable, i.e., must be delivered under Basel III compliance rules. Anything that turns up at the fix must be T+1 deliverable, 1 day deliverable physically. So these T+1 spot market fixes, they ultimately determine a global market deliverable price, and it's underpriced. However, physical market liquidity has broken free of the West's toxic gold price concoction, that's all I can think it is, into the BRICS-centric SGE and international-facing SGEI physically settled trading hubs, where a competing real supply-demand price is fixed twice a day. Now, this price is a real price. This price feeds into the rapidly expanding Western-facing gold corridor, pushing back where Western paper to global physical differences are systematically arbitraged by central banks, sovereign, and very large institutional buyers who have exited these COMEX exchanges, understanding, as the central banks do and the sovereigns do, that this is a 54-year-old legacy marketplace that is so deeply underwater from a paper to physical perspective, they've become vulnerable. They're literally being targeted for this bullion. So what we're seeing is when we see periods of backwardation, this activity to arbitrage these differences actively steps up. I mean, significantly. So futures to spot foreign exchange backwardations can only exist following the creation and selling of synthetic leveraged gold supply, which determines the non-deliverable cash settle price, which is so blatantly at odds with the global physical supply demand prices. However, those that look purely are siloed within that COMEX exchange. A lot of US traders look at, and the speculators, momentum traders, chasing a dot up and down a screen, they don't see anything beyond that is the price to them. And it really is why they're wrong at both ends when suddenly they see, hey, hang on, what used to work doesn't work. So quite simply, the larger the size that I or anyone else or client wishes to buy exponentially increases the price above the published prices, even the FX fixes, which are limited to 3 to 5 tons out of the 600 to 800 tons of unallocated gold that sloshes about. So if I want big size, then you just literally index that and add the premium. So what people try and do is literally just nibble at it without taking too big an order, because what it does is exponentially push that price up. However, when you've got a price being set outside of the legacy market, it's almost irrelevant. So whereas the global facing liquidity providers servicing very strong unleveraged physical central bank sovereign institutional demand, while they stealthily arbitrage these mispriced, exchanged for physical basis spreads, i.e. the difference between this underpriced COMEX bullion, it's not bullion, it's underpriced synthetic gold versus the real cost to buy that, even though it may be diluted slightly in the West still before it enters the gold corridor. That basis spread, EFP basis spread, is definitely stealthily being arbitraged without raising too much drama. So short-term chart chatter that you look at aside, and again, deliberate chart chatter. In other words, excuses to pull the bids. Really, as we've shown in the chart sections, how pit managers come in, how options expiries, derivative expiries, mark-to-market events, how their footprints come in at the pit open, how these guys are desperately protecting a position, but are getting arbitraged. So what's happening is short-term chart chatter, as we say aside, it's these prices that ultimately translate into a higher physical supported stairstep. And this brings us to exactly where we are in the latest derivative gold related West to SGE wash and rinse cycled. Now we've now reached the inflection point of the current toxic wash and rinse cycle, where net of these arbitrage flows, there are no matching real offers to sell bullion for immediate delivery into current supply shortages. Backwardations reveal just the tip of this iceberg price mismatch.
The structure of the precious metals market is tightening rapidly as the largest COMEX delivery month arrives with unprecedented backwardations and sharply rising physical premiums. The recent wash and rinse cycle pushed futures into forced compression, exposing how deeply misaligned synthetic pricing has become relative to real bullion availability. Even after aggressive attempts to cap prices into first notice, spot markets continued signaling acute shortage conditions, with gold and silver both fixing at outsized premiums to futures, despite heavy interventions. These spreads highlight a system struggling to keep pace with genuine demand and reveal how quickly leveraged contracts lose credibility when delivery requirements approach. Across the physical hubs, global buyers continue absorbing available supply, while liquidity providers prepare for a post-BIS settlement rally driven by real-world constraints rather than paper flows. The expanding backwardations now point to a structural inflection, with mispriced contracts facing the risk of significant losses as physical markets take the lead. Let's get back to the interview.
Let's look at where we are as we enter the largest COMEX delivery month of the year. So drilling down into this month's action, it illustrates the LBMA CME is no longer in the driving seat. It's as simple as that. And despite the kitchen sink being thrown at gold futures into what we just discussed, showed in the most recent 1 and 2 wash and rinse cycle process that we just described, how that works. And that went through, so we saw the wash and rinse cycle, we saw the 4,400 spec rinse topping out and then coming down to 3,900, then which was the next major physical support level. And as we reaffirmed in our last episode, where we evidenced very liquid SGEI, central bank, sovereign, institutional buyers had aggregated higher at 4,000, which is why we said that's where support is. Liquidity buyers assessed they would provide the next major rally point following options and first notice on the Thanksgiving holiday. So when we say first notice, what we mean is all of these contracts are now coming into the largest delivery month of the year. So options is out of the way. First notice is technically on Thanksgiving. However, first notice is meaning when you have to take a 96% leverage contract and you have to fully fund it or stand for delivery or close it or roll it or do something to it. You can't just leave it in place. Now, most brokers will have their clients, speculators, force them to settle ahead of first notice, because if this happens on a holiday, you could wake up with a nasty shock. So and that would expose the broker. So most brokers would actually forcing these to be closed today. So today is kind of for the first notice day, even though it's a day early. So we would expect the next major rally point to commence after today's first notice. Now, there is going to be a Bank of International Settlements squaring event on Friday, which is a very shortened session. You know what? I think they're going to have a tough time getting, each and every month we've seen higher and higher and higher place for the Fed to square what they've borrowed from the Bank of International Settlements at the end of each month, the mark to market, they call it the BIS event, and it'll be higher. So likely, as I say, most traders are now required to fully fund December contracts or roll these positions into, which would be the February contract would be the next most liquid contract for gold. But given the unprecedented backwardations into this largest delivery month of the year, liquidity providers are anticipating the rally to begin to get traction directly after the Bank of International Settlement leases get marked to market on Friday, if not earlier. Now, last week's synthetically driven options compression, the derivative compression, where you have this huge amount of billions of dollars worth of paper contracts that have to get marked to market. So the insiders have suppressed the price just to simply get it to that point where they can mark it to market and then run for cover. That went up to a $7.65 backwardation to spot, unheard of, so close to first notice. Then last Friday's backwardations, we saw a low of the day in futures of 4,018 when spot was 4,022.50. Just to illustrate, this is the spot market evidencing a $4.40 backwardation, even so close, revealing an arbitrable discount was being alchemized into officials scrambling to cap underwater options sweet spots. Now, while the same paper to physical modus operandi applies to silver futures versus spot, it's just silver's not T+1 Basel III compliant. However, with global physically deliverable silver price being determined outside of the legacy LBMA CME ring fence, the LPMCL, physical market shortages and export controls are exacerbating supply constraints, have driven the silver to spot basis spread into even larger, unprecedentedly deep arbitrable backwardations. Now, last Friday, spot gold fixed, not just intraday, fixed at a 56 cents premium to silver futures. And it went as high as 60 cents, $3,000 per contract backwardation to spot. Now, come on. Why would that not get people's attention? It illustrates there was and is no LPMCL cartel supply to meet demand. They are wrong-footed. And given supply constraints exacerbated by export controls, liquidity providers assess this time around there will be little to any reverse arbitrage shipping of SGEI silver into London. So whereas last time we saw these big spreads and we saw bullion being shipped out from the US into London, Shanghai International Exchange to London, it's not happening. It's just not happening. There's the odd trader that's doing it, but no, it's not happening. No one's trusting this. These deeply backwardated conditions should not exist into a first notice event where 96% leveraged paper contracts have to be cash settled. They have to be fully funded for delivery, or you have to stand to deliver, or you're going to have to quickly roll them out to another, defer the issue and roll it out to a paper contract further out. But given such tight supply, it's as plain as day. These contracts are mispriced, and someone very big is about to take a very big hit, big enough to need a bailout.
Momentum in the metals market is now shifting into a phase defined by tightening liquidity, structural backwardations, and growing pressure across the synthetic pricing system. Each new delivery cycle exposes a deeper gap between paper valuations and the physical bids that continue firming across international exchanges. The inability of futures markets to realign quickly enough with real supply is creating the conditions for outsized repricing as institutional flows accelerate and bullion availability remains constrained. With the largest delivery month underway, the current spreads signal a market transitioning from quiet imbalance to visible stress, setting the stage for stronger follow-through once derivative compression and end-of-month clearing are resolved. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.